Some of the key themes that played out during reporting season was we saw real underlying strength in companies that were leveraged to the domestic economy. In particular, the sectors retail, building and construction delivered very strong results across the board. On the challenging side, the banks in particular, with increased regulatory capital requirements, we started to see their EPS growth forecast being wound back, and also the increase of competitive pressures, in particular in the telecoms, food and grocery sector, and to a lesser extent, the insurance sector. Overall, sales growth was still very, very subdued, so a lot of companies had to deliver out on cost out opportunities to deliver on their earnings expectations. But also, I think, from a dividend perspective, the real surprise was both BHP and Rio abandoning the progressive dividend policies in order to maintain the strengths of their balance sheet moving forward in a very uncertain resource environment. But also there were dividend surprises. Two companies in particular that increased their dividend payout ratio, which was unexpected over the period, were IAG and QBE. Standout results during reporting season, in particular some of the retail companies. JB Hi-Fi, Nick Scali, Harvey Norman delivered very, very strong results on the back of strong sales, solid operating cash flow and maintaining their strong balance sheets. Other companies that delivered strong results also geared to the housing cycle, in particular BlueScope Steel beat expectations on the back of delivering on cost out initiatives and also strength in the housing sector. And Boral also started to see strengthening in their construction materials business and also their building products business. Boral also has the added tailwind of increasing infrastructure spend over the next 2 to 3 years, which will also add or aid earnings growth. On the negative front, Crown Casino, although they delivered very good top-line growth in their casinos in Melbourne and Perth, they disappointed on costs. Costs were a little bit out of control at the corporate level, and the market was a bit underwhelmed by that. Also, CSL, although they delivered very, very solid operating results, guidance around their recently acquired flu business actually increasing the loss guidance took the market by surprise. Look, I think across the board when we looked at the results, there were a few clear things that we found once we met with companies. I think most interesting was the strength of the East Coast economy, in particular New South Wales and South East Queensland. The economies are very strong. We saw that come through in the numbers in Star Entertainment Group that owns casinos in Sydney, Gold Coast and Brisbane. Also, we saw it come through in the results of Boral, very heavily exposed to New South Wales, and also Stockland, very heavily exposed to New South Wales and South East Queensland. So that was very interesting. Also, speaking to the insurers, there's been a lot of negativity around the insurance cycle in Australia. We're starting to see signs of stabilisation there. Having spoken with IAG and Suncorp, personal lines are stabilising. Also, QBE, very much geared to the international insurance markets. We're still seeing some weakness there in premiums. Overall, other interesting themes, I think, was just the extent and the ability of the large miners to continue to take costs down. So they're continuing to cut CapEx, bringing operating costs down, also cutting dividends, but really to preserve their balance sheet in what's likely to be a very, very volatile and weak environment for commodities. The most interesting company meeting we had during reporting season, without doubt, I think, was the newly appointed CEO of Woolworths, Brad Banducci. Took the market by surprise, and people were quite negative on his appointment because it was an internal appointment and they were expecting someone from external to come in. Our view is Brad's a very safe pair of hands. He's got a very clear strategy moving forward. We also like the fact that he has been looking after the supermarkets business, and the chairman and also Roger Corbett, who is an advisor to the board, have had a good chance to have a look at him under the spotlight. And we feel that he's got a very good knowledge of the business and he's very clear on the strategy. He knows it's a difficult task to actually turn this business around, but he's got a very, very clear focus on how he can reinvigorate the sales line at Woolworths, and that's really what's needed. Some of the opportunities that we're seeing in the market today, we feel that Woolworths is very, very interesting, because we've got a market that's really focusing on the short-term earnings outlook. And yes, there may be some more pressure in terms of the short-term earnings of Woolworths, but what they're really missing is the bigger picture. And the bigger picture is this is a high-quality business that generates a lot of cash. It's been mismanaged in the past. We now have a new board. We have a new CEO. We have the closure of Masters, which was a loss-making business. And we feel that the market has missed that this is a high-quality business, market leader in its space, in a very, very attractive industry structure. So that's one opportunity we're seeing. We also think Suncorp is another opportunity, has a new CEO. They've had a little bit of issues with their general insurance business. We feel they have the strategy in place to turn the performance of that business around. Also, their bank has been a steady earner and generating very, very good returns for shareholders. What we like about Suncorp is it's much cheaper than its closest peer, delivers a healthy dividend yield, but also has excess capital that it may be able to return in the form of special dividends to its shareholders. In terms of what we're cautious about, healthcare for us seems a little bit expensive relative to their historical multiples. So the healthcare names aren't too expensive for us, but also we think infrastructure in particular, although they're delivering solid, dependable distribution yields, we feel that the market's not really focusing on their balance sheets and how highly geared they are. And we feel there should be caution exercised around those companies. Well, there are always pockets of value in the market, and I think what we're doing at Perpetual at the moment is we're trying to identify companies that have defensive earnings characteristics, not heavily reliant on the economic cycle to generate earnings growth, have strong balance sheets and can pay dividends through the cycle.